Hi there. Thanks for tuning in. Today, we're going to be doing analysis and valuation of Chegg Inc., the technology and education company, essentially. So, yeah, let's talk about what their mission is. So, their mission, they say, is to improve learning outcomes by putting students first, and they want to improve the return on investment in education by helping learners learn more in less time and at a lower cost. They essentially offer homework help, they offer study guides, they offer textbooks. So, yeah, essentially they're a place where students can go to hopefully perform better. And they offer a variety of services. They offer subscription services such as Chegg Study, Chegg Writing, Chegg Math, and they recently acquired the language learning app Busuu, which is basically a competitor to Duolingo and with which you can hopefully teach yourself languages, right? And they also have a couple of other business units, but the core of this is mostly their subscription services as well as their language learning app now, their partnerships with a few other apps, some advertising, and some textbooks that they can buy and sell as well. And hopefully, through having people subscribe and stay subscribed, they can make money in a sustained way. Now, here, this is taken from Chegg's investor presentation for 2023, and they're talking about their total addressable market, their TAM. And their TAM, they're saying, is 100 million total students that need some English language instruction. And these are mainly university students, some high school students in the US that will need help and that would subscribe to Chegg services potentially. However, this is an estimated future number, right? The real number is 8.2 million people who are subscribed to Chegg services in 2022, right? So there's two very different numbers here. This is a very theoretical number versus this is reality. And getting from here to here takes a lot of time. And it's also not clear what percentage this is going to change in future times, right? 30 years from now, are we going to have more students in the world? Are we going to have less? How does that change depending on how the world economy is doing, right? Maybe there's some common knowledge that apparently in recessions, people may re-enroll in school because it is very difficult to find a new job. Who knows, right? There are people who know more about that than I do. There are people who would be able to analyze that. If you work in education, maybe you have some insight into what college enrollment numbers look like during certain times in the economy, right? So that just depends, but this is them talking about their potential market rather than their real market. And their 2023 priorities are to expand this total addressable market. They're doing this through more than just their study apps. They're doing this through also the acquisition of Busuu, which means that you can use Chegg services now further on than in just college. And they're also trying to internationalize. So they're trying to have some localized content. They're trying to apply their stuff to people outside of the US as well. They're trying to integrate their stuff from Busuu. They're trying to maybe have more skill-based stuff that you can learn. So I can take an online course as a professional with Chegg, and all of a sudden I want to use them beyond me being a student, right? And they also want to have profitable growth, which I should stress is very different than growing profits. So they're trying to grow in a profitable way or in a way that doesn't hit their balance sheets too hard rather than them growing profits, right? And this will come into play later. And their strategic focus is this much. It's growing subscribers, having so much value that there's no point in unsubscribing, right? Extending their lifetime value. So as I was saying, if I'm out of college, maybe I still want to use Chegg products because they have language learning skills or they have other key skills for professionals and they want to grow profitably. So they want to invest in more content. They want to grow, get more people on board. And yeah, they want to have some partnerships even with mental health and wellness apps. I know they have some partnerships with the Calm app recently. I think that's sort of a affiliate program, or maybe they bring people to Calm and Calm gives them a sort of fee for that. That's what it seems like it's like. I haven't looked that deep into it. But yeah, so they're trying to expand beyond just being textbooks, homework, math help. So that's interesting. And here you can see how their subscribers have been growing, right? There was an explosion of subscribers in 2020. I imagine that is because of the global situation in 2020. However, you'll also see that the rate of subscription growth, especially from 2021 to 2022, slowed down a whole lot. Yes, there was a 28% increase on a year-over-year basis in Chegg subscribers, as well as a 26% increase in the revenue of Chegg subscription services. However, the rate of growth for that greatly slowed down from 2021 to 2022, and it is also going to slow down even further for the fiscal year 2023 as they are giving the guidance. So this is something that shouldn't surprise us if the revenue slows down a little bit or if their subscriber growth slows down, right? Now, they also grow a whole lot through acquisitions. This is part of the Wikipedia article written about Chegg, and this talks about how they made an acquisition in 2010, in 2011, in October 2014, in 2017, in 2016, in 2017, in 2018, in 2019, in 2021. That's a whole lot of acquisitions. So Chegg has always been trying to grow and grow their total addressable market through acquisitions, which is interesting. I also just wonder how much of this growth attributed here is through acquisitions. How many of these jumps are not through the organic growth of products Chegg actually offers, but through those acquisitions where all of a sudden they grab the company here and this increase is actually the clients of that company that they acquired rather than Chegg acquiring these new customers themselves. So that's something to note. I don't know truly the nitty-gritty of the numbers behind it, but yeah, it's a lot of growth through acquisitions. A lot of money is going here. They paid $436 million for Busuu, so that's very interesting. And here we're going to look at some financials. So if you'll see, there is revenue growth. Now it's flattened, right? Actually, it decreased from 2021 to 2022. They have gross profit, but they barely have income from operations now. They had some before. They barely have some now. But then you'll see that in 2022, they had some net income as opposed to 2020 and 2021. Why is that? Well, you'll see here that the two biggest parts that composed the net income for Chegg in 2022 is actually interest income and then income taxes. They got a tax benefit, actually, instead of paying taxes. They pay taxes in 2020 and in 2021, but in 2022, they actually got a tax benefit. Same with interest. They paid interest, I assume, on their debt or on anything they may have taken out with banks. And they paid interest in 2020 and in 2021, but they received money from that in 2022. These things are probably one-time things. So even though the net income here is positive, and look at the earnings per share especially, here it says there's minus 0.05 cents per share or minus 1 cent per share here. But now all of a sudden you have a diluted earnings per share of $1.34. So this number is very deceiving because this is a one-time thing. These earnings per share are fairly arbitrary, especially because in fiscal year 2023, assuming they don't get another tax credit or they don't get another huge gain from interest, which they haven't before, so I don't see a reason why they would, then this net income is going to go back to the negatives or back to near zero, I suppose. So I don't know. I find it very interesting that this is the case, and that's also why I am going to use free cash flow for my calculations, because I find earnings per share very deceiving like this, right? This means nothing if these are all just one-time things. What about margins? So here they, thankfully in their 10K, they show the margins of everything. Where does everything go? So for example, you can see that gross profit is 74% of revenue. That's good. But then all of a sudden, operating expenses is 73% of revenue in 2022. So then you're left with nothing. Their income from operations is just 1% of revenue. Their operating margin is 1%. Before that, it was 10%, which is more, but it's not great either. So they have a crazy amount of money going away, mainly in research and development and general and administrative expenses. That's a whole lot of money going away in expenses. I don't know. That's a whole lot. That's a whole lot of fixed costs, especially. These won't change that much year over year, especially now as they're acquiring and acquiring and acquiring. So that's very interesting. And their net income margin here, sure, it looks like it's 35% of revenue getting turned to net income, but this is not really the case, as we talked before, because a lot of it comes from these tax provisions, these tax benefits that they're getting that we can't count on every year, right? Now, they also talk about free cash flow in their investor presentation. And free cash flow has been something that has been positive, always. They have had 34% year over year return on free cash flow since 2016 to 2023 with their estimate that they're giving us. And that's very, very interesting. So clearly free cash flow is a priority for the company, and we can use this number to do our calculation for their value. I will say something interesting, that for free cash flow, they're basically grabbing cash flow from operations, and then they're subtracting the purchases of property and equipment and the purchases of textbooks, and then adding back the proceeds from the sale of textbooks, right? Other websites may not include this last part, proceeds from disposition of textbooks, in the capital expenditures. So this is something where their 10K and their investor presentations versus your own calculations grabbed from other websites such as Yahoo Finance or Seeking Alpha may look different. So that is just something to note. I'm going to use some free cash flow numbers that don't include these adding back these proceeds from disposition of textbooks, simply because it's easier to find historical data on capital expenditures without this item. So that's why I'm going to do it. It's not going to be hugely different. Like, it's, a couple $1 million, but it's not massively different in the grand scheme of things. So I'm going to estimate free cash flow. And what I'm doing here is I'm grabbing revenue and I'm grabbing free cash flow, and I want to see what percentage of revenue is turned to free cash flow, right? And generally, it's on average with the last 5 years about 17.4%. However, this has been increasing, so I'm going to be generous to Chegg, and I'm going to say in the future, for my estimations, for my models, they're going to turn 20% of revenues to free cash flow. They have done this before, and the trend indicates that they may be able to do this in the future, right? Based on that, we're going to do a discounted cash flow model. Now, revenue is basically going to either decrease a little bit or stay flat, but there's going to be a slight increase in free cash flow in 2023, according to my model, because they're going to turn 20% of revenue to free cash flow, which is slightly more than before. And then from there on, I'm going to grow revenue at 5% per year from 2024 to 2026. And then I'm going to put these numbers in my free cash flow calculation, and I'm going to say that I want a required rate of return of 11% per year, a perpetual growth rate of 2%. This is how much they're going to grow in perpetuity. You can change this number if you're doing your own calculation. And with that, I'm going to get a fair value of equity when dividing by the number of shares of $14.10. And then I'm going to adjust this for the net debt. So with their net debt that they have a little bit of, but they don't really issue a lot of debt themselves. They're mostly paying down debts that already existed. They have a fair value of $12.90. So these are with these assumptions that are maybe a little bit mean to the revenue growth rate of Chegg, although it has slowed down a lot. But I'm saying they're only going to grow 5%. What if we change it to 20%? Well, if we're assuming 20% revenue growth, the numbers change completely. Even with these same assumptions of a required rate of return of 11% and a perpetual growth rate of 2%, the fair value of equity is basically $20, and post-debt, it's $18.79. So that's very interesting. Where's the stock price at? Well, you'll see as of April 17th, it's around $18. So in order to justify this valuation, we're assuming a growth rate of the revenue of 20% per year from 2024 to 2026. That's a lot. That can be a big ask. And you'll see here that the stock price of Chegg is very interesting. In the last 5 years, it's been through quite a journey. You'll see, first of all, the PE ratio is 10. This is because it had positive earnings recently. And guess what? We just talked about how these earnings are mainly from one-time things that are probably not going to repeat. So looking at the PE ratio and saying this is cheap because the PE ratio is 10 or it's under 15 or it's under 20 or whatever, it's not really the way to go. Because just because it has a low multiple does not mean it's cheap. Because this low multiple is probably from a one-time thing. You'll also see that Chegg had quite the overperformance from 2020 towards the end of 2021 and then just cratered in value. And that also just shows that buying it around here is just pure speculation. People are betting on growth, but as we saw, Chegg didn't really have any profits back then. They had some free cash flow, but they're betting on this huge amount of growth here. And I'm sure if you bought it around here and are still holding nowadays, you're probably very unhappy. So yes, we are betting on growth for Chegg, but how much are you actually willing to pay for growth? Because you just saw that around the price it is now is assuming with this discounted cash flow model that it's going to have 20% revenue growth for 3 consecutive years after 2023. And that's a whole lot. So I'm going to give you 2 scenarios about what could happen with Chegg. One of them is that the reduced growth sticks, that the revenues grow at 5% per year from 2024 to 2026. With that said, the stock is clearly overvalued. The price to buy it at, if I apply a margin of safety of 30%, which I think is more than fair because they have huge fixed costs and there is a lot of uncertainty there, the price to buy it at then would be $9.03. Even with slightly improved free cash flow margins, that is simply not enough. And I must stress that expanding the total adjustable market, or the total addressable market, my bad, is not equal to revenue growth or to profit growth. They're trying to get more users, but are they fully monetizing those users? Are they focusing on growing profits? They're not. So if reduced growth is a thing, well, there may be trouble for Chegg in the horizon. It may just be overvalued. The second scenario is that strong growth continues, and this grows at 20% for 2024 to 2026, as I was saying. Then it is fairly valued, right? I got a fair value of $18.89, I believe, and right now it's at about $18. So if you apply a margin of safety, maybe it's around there, maybe it's a little bit overvalued. It isn't impossible for Chegg to grow 20% per year from 2024 to 2026. Chegg has posted great growth numbers before, but growing that much gets more difficult with size, right? It's a lot more easy to double the amount of users subscribing to you when you have 1,000 users and you want to double it to 2,000 than when you have 10 million and you want to double it to 20 million. It is a whole lot harder for sure. So now that Chegg is growing a lot and has grown a lot, to keep posting those numbers is a pretty hard ask. So I must ask, what does growth look like? Clearly, they're stressing that they want to grow the amount of users, but are they also growing profits with it? Are they going to grow free cash flow that much and the revenues as well? I don't know. And that is something where if we're paying for growth, we have to see what kind of growth the company is looking for and if that aligns with our personal investment goals as well. With that said, I thank you so much for watching. If you have any questions about this valuation, feel free to comment down below. And if you want to see more videos like this, or if you want me to analyze any particular securities, comment them as well. And if I find them interesting, I'll take a look at them. With that said, I hope you have a fantastic rest of your day. Thank you so much for watching, and have a great one.